Let me tell you something that should make you physically uncomfortable right now. For the past 2 years, while the NASDAQ climbed 70% and turned every $10,000 into $17,000, software stocks, the so-called backbone of the modern economy, the sector that every financial magazine told you to own forever, went down 8%. Not sideways, down. So while your neighbor, your coworker, the guy at the gym who never even talks about stocks, quietly doubled chunks of his portfolio riding the index, you sat there holding your high-quality software names and watched $10,000 shrink to $9,000. That is not bad luck. That is a failure of understanding. And if you do not correct that failure right now, today, in the next 20 minutes, the next rotation that is building right in front of your face is going to pass you by the same way this one did. The unthinkable is about to happen to stocks, and you need to be positioned before it does, not after. If the last 60 seconds made your stomach drop even slightly, that means you still have the instinct to survive financially, and that instinct needs to be fed every single week. Hit subscribe right now. Not later, now. The institutional money managers on Wall Street charge clients 1 to 2% annually, plus performance fees, to hear exactly what I'm about to walk you through in the next 20 minutes. You are getting it for free, but only if you are subscribed. This channel is where I break down what the professionals are actually doing, not what they tell the press they are doing. So subscribe, hit the bell, and let us get into it. Now let us talk about exactly what happened over the last 2 years, because if you do not understand the anatomy of the mistake, you will repeat it in the next cycle without even realizing it. The NASDAQ 100, tracked by the ETF with the ticker QQQ, went up approximately 70% between early 2024 and mid-2026. 70%. That means a $50,000 investment in QQQ became $85,000. That is the kind of number that changes a family's financial trajectory. Meanwhile, a basket of the largest and most well-known software companies in America lost approximately 8% of their value. In the exact same window, you are talking about a gap of nearly 78 percentage points between two things that most retail investors would assume would move together. They do not. They never did. And the reason they diverged so dramatically comes down to one very powerful narrative that took root on Wall Street around 2024 and grew like a weed through every hedge fund, every prime brokerage desk, and every institutional portfolio manager's morning meeting. The narrative was simple and it was terrifying. If you were a software investor, the story went like this. Artificial intelligence is going to make traditional software companies obsolete. Why would any enterprise pay for an expensive SaaS subscription when an AI model could replicate that functionality at a fraction of the cost? Why would anyone pay for project management software, analytics, dashboards, customer relationship tools, or workflow automation platforms when a sufficiently capable AI agent could perform those same functions on demand for pennies? It sounds logical. It sounds inevitable. And because it sounded both logical and inevitable, the most sophisticated pools of capital in the world, hedge funds managing tens of billions of dollars, decided to get paid to be right about it. They did not just sell their software positions. They went short. They borrowed shares they did not own, sold them into the market, and collected cash, betting they could buy those same shares back cheaper later and pocket the difference. And it worked brilliantly. Those funds made an estimated $24 billion this year alone, betting that software stocks would decline. $24 billion on a single directional thesis. And when that scale of capital is positioned on one side of a trade, it does not just reflect reality, it creates reality, at least temporarily. The weight of that selling pressure is enough to suppress any positive catalyst, to overwhelm any good earnings report, to drown out any rational valuation argument, and so software sat there, pinned down, bleeding slowly, while everything around it soared. But here's what those headlines never tell you. And this is where most retail investors completely fall apart in their analysis. A narrative being powerful does not make it correct. And more importantly for our purposes today, even a correct narrative can be fully priced in, meaning the market has already moved as far as it is going to move based on that information. Ask yourself a direct question. Have you canceled your Microsoft Office subscription? Have the companies, stopped using Salesforce? Has your employer ripped out their enterprise software stack and replaced it with AI prompts? Of course not. Because the reality is that while it is dramatically easier to build new software today than it was 5 years ago, acquiring the installed base, the millions of paying subscribers, the enterprise contracts, the data integrations, the compliance certifications, none of that has gotten easier at all. The moat did not disappear. The narrative just made everyone forget it existed. And when the market forgets something real, and when that forgetting reaches an extreme, it creates an opportunity that does not come along often. So now you understand what happened. The question that actually matters is what happens next, and more specifically, how do professionals identify when a reversal of this magnitude is approaching so they can be positioned before the crowd figures it out, because the crowd does not make money. The crowd is the mechanism by which early movers get paid. You need to understand a framework that I call the rubber band effect, and you need to internalize it completely, because it applies not just to software today, but to every major sector rotation you will encounter for the rest of your investing life. Picture a rubber band held between both hands. When you stretch it in one direction, energy accumulates inside the band. The further you stretch it, the more tension builds. And critically, the rubber band does not gradually return to center. When the tension becomes too much, it snaps. It whips back fast and hard in the opposite direction, often overshooting center entirely before settling. That is exactly how crowded trades unwind in financial markets. And the software sector right now is a rubber band stretched about as far as I have seen in many years of watching these setups. The first thing a professional does when evaluating a potential snapback trade is measure exactly how crowded the short side has become. This is called positioning analysis, and it is not complicated once you know what to look for. Positioning tracks the ratio of money betting a stock or sector goes down versus money betting that goes up. Under normal market conditions, that ratio stays relatively balanced. Some pessimists, some optimists, and the stock reflects the genuine consensus of both camps. But in software right now, that balance is broken down completely. Short interest across major software names is at levels not seen in years. We are talking about a situation where the overwhelming majority of institutional bets are pointed in one direction: down. And here's the mathematical reality that most people never think through. When positioning reaches that kind of extreme, you are running out of new sellers. Everyone who wanted to bet against software has already made that bet. The trade is crowded, the easy money has been made, and now the trade is vulnerable to any piece of information, any earnings beat, any contract win, any macro shift that makes the thesis look even slightly less airtight. The second step in identifying a snapback is finding what I call the crack, which is the first technical signal that the price suppression is failing. In practical terms, this means watching for a price level that has acted as a ceiling multiple times, a level where the stock or sector has repeatedly tried to break higher and been pushed back down, and waiting for the moment that ceiling finally gives way. Looking at XSW, which is the ETF that tracks a broad basket of software companies, you can see that the price has bumped up against the $160 level several times over the past many months and been rejected each time. That level represents accumulated selling pressure from shorts defending their positions. Every time the price approached it, the bears added to their shorts to keep the lid on. But here's what that pattern actually reveals. Each time they successfully defended that level, it cost them capital. It cost them firepower, and the more times they are forced to defend it, the closer they are to running out of ammunition. When XSW breaks cleanly and closes above $160 with volume behind it, that is the crack. That is the rubber band beginning to slip from the hand that was holding it. And the third step is where the real violence happens. Step 3 is forced buying, and this is the mechanism that can turn a modest sector rotation into an absolutely explosive move in a very short period of time. Here is the cold mechanics of how it works. Every short seller in software right now has a position that looks like this. They borrowed shares, they sold those shares, they received cash, and they are sitting on a profit as long as the price stays down or continues falling. But the moment the price starts moving against them, their profit evaporates and they begin facing losses. And unlike a regular investor who can simply hold their long position and wait for it to recover, a short seller has a hard deadline. Their broker is continuously calculating whether their collateral covers their potential loss. If the price moves up fast enough, brokers start issuing margin calls, which are basically demands to deposit more money or close the position immediately. And the only way to close a short position is to buy the stock. So you sold shares you did not own. To settle that transaction and get back to zero, you must buy shares. So when a heavily shorted sector starts moving up, you get a mechanical, forced wave of buying that has nothing whatsoever to do with anyone's fundamental opinion of the companies involved. These short sellers are not buying because they suddenly love software. They are buying because their broker is calling them and their account is getting destroyed and they have no choice. That forced buying pushes the price higher, which triggers more margin calls, which forces more buying, which pushes the price higher still. It feeds on itself. To understand the scale of what this can produce, look at what happened to the car rental company Avis a few years back. Avis was heavily shortened. The bears had a legitimate thesis. The stock had declined 50%, and the short sellers were printing money. Then the price started moving back up, slowly at first, and then without warning, it accelerated into something that looked less like a stock chart and more like a vertical line. The forced buying cascade took over, and the stock moved hundreds of percent in a matter of days before eventually cooling off. Now, that kind of violent, extreme move requires some specific conditions that may or may not fully replicate in software, but the underlying mechanism is identical. And the setup in software right now, with institutional short interest at multi-year highs across a broad basket of well-known, well-capitalized, still profitable businesses, is about as close to those conditions as I have seen in a long time. The trigger could be a strong earnings report from a major software company that forces analysts to revise their AI disruption timeline. It could be a macro catalyst, like interest rate movement, that makes growth stocks suddenly more attractive. It could simply be the slow grinding weight of short sellers voluntarily closing positions as the thesis fails to play out on their expected timeline. However it starts, once it starts, the mathematics of forced buying take over. And you want to be in position before that happens, not chasing it after the first 15% move is already gone. Now, for investors who understand this setup but want exposure without the volatility risk of picking individual names, the cleanest vehicle is the ETF ticker XSW. This fund holds approximately 136 software companies, which means you are not making a concentrated bet on any single business model or management team. You are betting on the sector rotation itself, on the broader forced buying dynamic, on the reversal of a 2-year narrative that has run its course. The fund is currently down roughly 7% over the trailing 12 months, which tells you exactly what you already know. The suppression is real, and it has been effective. But that same underperformance is precisely what creates the asymmetry here. You are buying something that has been beaten down by institutional selling pressure at a time when that selling pressure is mathematically approaching exhaustion. For a conservative investor who wants meaningful upside exposure without individual stock risk, XSW is the instrument. Size it appropriately within your overall portfolio. Do not over-concentrate. And understand clearly that this is a thesis trade with a specific catalyst expectation, not a buy-and-forget position. If the thesis is wrong, cut it. If the thesis plays out, have a price target in mind before you enter, so that emotion does not make your exit decision for you. Now let us talk about the 3 individual stocks that represent higher risk, higher reward expressions of this same thesis. Because for investors who understand position sizing and can tolerate greater volatility in exchange for greater potential returns, individual names offer something an ETF cannot, which is a specific catalyst story layered on top of the sector-wide dynamic. The first name is CoreWeave, and this one is different from the other two in an important way. CoreWeave is not being suppressed by the AI will kill software narrative. It is actually a direct infrastructure play on AI expansion. What CoreWeave has built is a specialized cloud computing network packed not with general-purpose servers, but with the highest performance GPUs available, the exact hardware that AI model training demands at industrial scale. This is not Amazon Web Services or Microsoft Azure offering AI as one feature among thousands. CoreWeave built their entire infrastructure for one purpose: to rent GPU compute capacity to AI companies that need to train and run their largest models. The demand side of that equation is not in question. AI compute demand is growing faster than virtually any forecaster projected 2 years ago. The supply side is constrained by capital, by physical data center space, by power infrastructure, and by access to the GPUs themselves. CoreWeave has spent aggressively on all 3, and they have locked in long-term contracts with a meaningful forward revenue backlog, which means a significant portion of their future revenue is already contractually committed. They have a formal partnership with NVIDIA, which is the company that manufactures the hardware that makes their entire business model function. Looking at the chart, CoreWeave has just broken above its recent resistance highs, though a cleaner entry confirmation would come with a sustained close above the $140 range. The big sell-off appears to be over, and the stock is in a gradual repositioning phase. This is not a stock you buy because software might rotate. This is a stock you buy because the AI infrastructure build-out is an infrastructure supercycle, and CoreWeave is positioned at the center of it. The second individual name is Big Bear AI, trading under the ticker BBAI. And I want to address directly what every experienced investor immediately thinks when they see a company with the word AI bolted onto their name. Yes, it smells like 2000. Yes, The dot-com era is littered with the graves of companies that added a trendy word to their name and rode the hype straight into bankruptcy. I am not dismissing that concern. I am raising it because you were going to think about it anyway, and I would rather address it head-on. The thing that separates Big Bear AI from pure hype is the customer base. These people are not selling AI tools to small businesses or consumer apps. Their primary clients are the United States military and federal government agencies. Specifically, Big Bear AI builds AI-powered software for processing and interpreting massive, complex datasets in national security and defense contexts. Think predictive logistics, supply chain intelligence for military operations, computer vision applications for defense contractors. This is not a company selling a chatbot to a marketing department. This is a company embedded in the defense technology supply chain at a moment when the United States government is actively, aggressively, and with bipartisan support, increasing its AI defense spending budget. BBAI has been winning contracts. They have a backlog. They have real government relationships that took years to build and that represent a significant competitive moat because you do not switch your national security software vendor the way you switch your project management tool. The stock is down roughly 70% from its all-time high, which sounds alarming until you recognize that this is exactly the kind of punishment the market hands out to small-cap growth names when a sector-wide narrative turns negative. The stock appears to have found a floor around the $3 range and is showing early signs of technical recovery. There will be resistance zones on the way up, where traders who bought higher will sell into any rally to recover their losses. That resistance is not a reason to avoid the name. It is a reason to understand what you own, size it appropriately for the volatility it carries, and not panic when the inevitable pullbacks within an uptrend occur. The third name is Unity Software, and this is perhaps the most straightforward valuation story of the three, which also makes it the one that is most painful to look at from a historical price perspective. Unity is down approximately 87% from its all-time highs. 87%? That means if you had bought Unity at the peak, you would need roughly a 750% return just to get back to even. I'm not telling you this to make you feel sorry for existing Unity holders. I am telling you because that kind of drawdown on a company with a real, defensible, industry-standard product used by millions of developers globally is the definition of a rubber band stretched to its limit situation. Unity builds the game engine that powers a majority of the world's mobile games, a significant portion of PC and console titles, and an increasingly important slice of industrial simulation, architectural visualization, and what the technology industry calls digital twins, which are virtual replicas of physical environments used for planning, training, and testing. None of that business went away because the stock dropped 87%. The developers did not stop using Unity. The game studios did not rebuild their pipelines around competing tools. The product is still deeply embedded in the workflows of millions of creators who would face enormous cost and disruption to switch. Unity has also been doing the unglamorous but necessary work of cutting costs, streamlining operations, and moving towards sustainable profitability, which is exactly what you want to see a beaten-down growth company doing. They have introduced new AI-powered monetization tools, including Unity Vector, which helps developers optimize in-app revenue generation. The stock appears to have established a double-bottom technical structure around $17.50, which coincides with support levels from the prior year. That pattern, a stock finding the same floor level across multiple time periods, tells you that buyers are showing up at that price and defending it. The bull case here is not complicated. This is a dominant technology platform in a growing industry that has been punished disproportionately by a narrative that does not specifically apply to its business model, and that is now trading at a level that compensates you for the risk you are taking. Let me be very direct with you about where we are right now. You have just been handed a framework, 3 specific stock ideas, and an ETF entry point that represents a real, data-supported, institutionally recognized opportunity in a sector that has been systematically suppressed for 2 years. What you do with this information will tell you everything about your financial future, not just with this particular trade. But as an investor in general, the investors who build real, lasting wealth are not the ones who get lucky on one stock. They are the ones who learn to recognize the mechanics of how money moves, how narratives get built and destroyed, how positioning reaches extremes and then violently unwinds, and they deploy that understanding repeatedly, cycle after cycle, sector after sector, year after year. The people who stay poor are the ones who keep doing what their parents did, buying and holding through technology disruptions that can cut a stock's value by 80 or 90% before the narrative finally shifts. The world is moving too fast for that approach now, and you know it. So here is your binary choice. You can close this video, do nothing, and watch the next rotation happen in your rearview mirror the way the last one did, or you can subscribe, do the work, learn the system, and be positioned before the crowd figures out what is already happening. There is no middle option. Subscribe right now. Share this with one person in your life who you think is making this mistake, and I will see you in the next one.